So, good afternoon. Lunch and Learn again, and today we're very honored to have 1031 Exchange, Rick here from 1031 IPX Exchange. And IPX is an intermediary company that handles all of our clients' 1031 exchanges. I've been working with IPX for almost 20 years, which is as long as I've been in the business. So Rick has been kind enough to come and talk to us about the basic exchanges. And Rick, come on up.
All right, thank you, Linda. Pleasure to be here.
You need to stand kind of right
I'll
here.
stand here so that the video can pick me up. But like Linda said, we specialize in, well, that's all I do primarily, is 1031 exchanges. So today's class is just going to be on the basics of a 1031 exchange. Just cover the details in the future if we want to go through there. So what my job is at IPX is that I run the state of Arizona and New Mexico, which I supervise every exchange that comes through our state. And there's so many different types of exchanges. There's reverse, there's all those other complicated exchanges that we're not going to really get into too deep today, but we'll cover the basics. And like I say, in a future class, we can maybe go into the more advanced stuff.
Rick, are you okay if we just kind of ask questions?
Yeah, absolutely. Feel free.
If you guys need to ask a question, please speak up so the audio picks you up.
All right, perfect.
Okay.
So I like to start off all my classes with one question. I mean, there's going to be a lot of information I'm going to cover here today, but the biggest thing and the most important thing that you will get from this class is what? Any guesses?
More money to spend.
More money to spend, but the most important thing is my contact information. So that if you have any questions or anything, you're working with a client over the weekend, or if you have a scenario that comes up that's related to a 1031 exchange, you can text, you can call, you can email me, and I'll get that answer back to you so that you can have that in front of the customer in a time-sensitive manner. So the information basically is that if you can have an expert on your database that you can contact to do a 1031 exchange, this is that's most important. Okay, so let's see, we'll click the next slide here. Oh, it works perfect, I like that. Or not, there we go. That was weird, huh? Okay, so investment property exchange services, that's what IPX 1031 stands for. I also offer CE classes for the same type of class that we're doing today. It's just stretched out a little longer, a little bit more detailed, and it's a 3-hour CE credit for real estate. Okay, so like I said, the purpose of this course is to get an understanding for why to do an exchange. And of course, there's a tax and then there's a non-tax reason to do that. We're going to cover the codes and so on. So this is going to give you the basic understanding of a 1031, the benefits of a 1031, and some idea on how to use a 1031 and tax updates and new strategies. This slide here, it's so busy right now that I haven't even had a chance to update it, but everybody knows back in 2004, 2005, the real estate market was crazy busy, so much that it created a bubble. And we're actually at that stage now, not so much a bubble, but it's been going up 2014, 2016. Where we're at now, it's almost, I wouldn't say it's 2005 numbers, but it's right around in between 2003 and 2004. That's the reason why I kept the slide with the 2003 and 2004 up there, is to show we're at that level again. Not the crazy level of 2005, but right at the 2003, 2004. So 3 property types. Everybody knows there is the primary residence. I don't handle primary residence, but you should know what a primary resident tax code is for that. It's under the section 121 of the tax code. There is no recognized gain or non-recognized gain with that. The only requirements is for this one to qualify for 121 is that you have to live in the property for 2 out of the 5 years. So if you are investing properties and you eventually want to turn it into a primary residence, you have to occupy it for 2 years out of the 5. There are some exclusions under the 121 code. If you're a single taxpayer, you have $250,000 exclusion for a gain. And if you're married, filing jointly, there's a $500,000 exclusion. So what that means is that if your sale and you have a gain that's larger than either one of those numbers, depending on how you're filing, you only have to pay capital gains tax on above those numbers. Question? Yeah?
What if that owner-occupied house happens to be like a duplex or a fourplex?
Well, if you're occupying one unit out of the, say, a fourplex and the other three are investments, it would qualify for both of the codes. So the one that you're occupying would fall under the 121. The three other properties are investments. So as you sell, or you sell it as one sale, it'd be like a 25-75 split, or whatever the direction of it is on the sale.
So you could
do
take the 25% off of the unit that you're in.
Right.
It's a fourplex.
Mhm.
So that would be tax-free if you live 2 out of the
If
5
it's under these numbers, yes, exclusion. And then the difference would be an investment side. So it just breaks down the percentage of it. So you would actually fall under 2 tax codes on that sale. And then carry that over to the new property on what your intention is on that side of it. If you're doing the same type of thing, that owner occupied for a percentage and the other percentage is going to be investor, or you're going 100% investor, then you would fall into a different percentage.
And remember, not only does this company have relationships with IPX
Mhm.
to talk about that, but we also have a great real estate CPA that will sit down and chat with you as well, so
Mhm.
that you have all the answers so you know exactly which way to go.
Right.
Or not go.
Right, and I also represent, for IPX, we have in-house attorneys that are at your exposure. You can contact them if there's a question that I can't answer, that's above or needs to be a little bit more complicated. Linda knows this, she called and tax Jim Miller, which is our in-house attorney, and he's there to help out structure any transactions. Again, all these services is for future business, hope of future business with us. Okay. So, I'm going to not touch too much on the 121, but if you have questions, slow me down a little bit, because this is more just general knowledge. But under the primary residence, second homes and vacation homes fall under the 121 if they're not rented out. If they are rented out, then there's a portion of that, like your example with the fourplex, that would fall into a percentage breakdown depending on what the percentage of rental is. So again, recognize on the sale. Now the investment property, that's where we come in. That falls under the tax code, the 1031 exchange. So then that's not really excusing your gain or your taxes, it's just deferring it as long as you purchase more property. But you can defer that as many times as you like, indefinitely, until upon your death. And then your heirs would receive the property and all that back taxes. What do you think? They have to pay that, or what do you think?
Falls under estate taxes.
What's that?
Estate taxes.
Yes, in the estate taxes, if it's $5 million plus, they would have to pay estate taxes on it. But if it is a property, say that fourplex, they own that fourplex and they inherit that fourplex 10 years from now. Dad bought it for $100,000, now it's worth $600,000, so there's a large gain. Dad passes on, daughter or son inherits that property. Do they have to pay that tax? The answer is no. The only way you can avoid paying any tax is death. That person that inherits that property gets what they call a stepped up basis, so it's just like if they purchased it for $600,000. So if they decide to sell it at that moment, when they inherit the property, there is none of that back tax that Dad has been deferring as due. So it dies, the tax that's been deferred dies with the original owner.
And that's a really interesting point.
Yeah.
Then, and what happens if the ownership is in an LLC? Right? Does that change?
It depends on the LLC and how many members. If it's a single member LLC and Dad was the only member of that LLC, it dies with him. If there's 3 or 4 other partners, well then it obviously stays with them. His just percentage of ownership would go to his heirs. And then that would be a step-up basis, whatever that percentage of value is. And again, it depends on how it's titled. I always recommend titling the property, if it's an investment property, with partners, to title it with tenants in common, because then it's easier to break off and do an exchange than if it's titled in different directions. So remember that tenants in common is the best way to title a time that you're buying investment properties for this type of purposes.
When there's multiple owners.
When it's multiple owners, yes. When it's an individual, it doesn't matter as much on that side. Yeah, because that's the biggest thing. If it wasn't title in common title on that property, then they sell that property, or they're forced to sell that property if one person of the membership dies and the other wants just to cash out. Then they either have to change the title and wait a year before they do anything, or they have to buy that individual out, the other partners. And sometimes that may not be possible. So to avoid that would be the tenants in common. And we'll show a little bit more as we go through here. Okay, So, well, of course, there's choices. The first one is you do nothing when you have a sale of an investment property. The other is to sell and pay your taxes. A lot of people have a hard time writing that big check, but eventually you will, for the most part. And state and federally, this is just a range because I can't give you exact numbers of what your taxes are going to be. That's more the tax advisor, your tax accountant that will give you those numbers. But it's based on your income, your tax bracket that you're in. So for federal and state combined, it's anywhere from 15 to 32 or 33% that you'll end up paying in capital gains. So a $100,000 gain, simple math, you're paying about $34,000 in capital gains, okay? The other one is that you could sell the property and take back a note or structured sale. What that does is that you're not getting all your gain in one taxation year. You could spread it over 5 years. You're going to be paying taxes, but you can do it over a 5-year period. It's a little bit easier to absorb that way. But you're not deferring it. You're not doing a 1031 exchange with that.
In fact, seller carrybacks do not qualify for 1031.
Unless they're within the under the 180-day guideline for the 1031 exchange, which most seller carrybacks are at least 2 to 3 years. So 180 days is not going to work for that. And then the other option is that you can do a 1031 exchange, which is like we're here today to talk about to defer those taxes. Okay. So I always put this in my presentation. This is if you went to IRS.gov's website and want a definition or them to explain what a 1031 exchange is. This is what you'll see. It's a non-gain loss shall be recognized on exchange of property held for productive use in trade or business for investment if such property is exchanged solely for the property of like kind which is to be held either for productive use in trade or business or for future investment. Pretty clear as mud, right?
That's the IRS.
That's the IRS. Some key words though that are in that paragraph is held for productive use, exchange for like kind. But it doesn't really define what like kind is. Anybody know what like kind is? Other than you, Linda, I know you know. Like kind is not so much like a duplex for a duplex. It just has to be, like it says here, investment held for productive use, business, or investment. So you can go from a fourplex to raw land. You can go from raw land to a commercial building or a commercial building to single family. As long as it's not one thing, it cannot be its primary residence or second home. That's solely used for primary purposes. So basically anything that is real estate that is held for investment purposes is like kind, okay? We'll go into that a little more detail here too. So the reason why most people want to do an exchange is obviously they bought their property maybe after the balloon, the bubble burst, and they got a really good deal at an auction, or they're doing it currently. They're buying properties and they held on to it for the last couple of years. Real estate is going up 6-7% here in Arizona, so you're creating a lot of equity. You don't want to end up paying 34% back to Uncle Sam when you sell that property. So that's one of the main reasons why I'm very busy right now, is because people want to preserve that equity to do a 1031 exchange so they can buy more real estate. Okay, so when you sell an investment property, what are the taxes you have to pay? This is just like I said earlier. This is breaking it down even further for you. Depending on what your tax bracket is, you have federal capital gains anywhere from 15 to 20%, depending on what your income bracket is. State, depending on where the property is held, is what tax you'll pay state-wise. And there's states obviously that are 0 all the way up to the west and east coast, California and New York, where you have the highest taxes, state capital gains taxes in the country. Here in Arizona, it's about 5%. And then this one here, some people don't realize unless they've been sold an investment property and they filed their taxes a year later and didn't do a 1031 exchange. There's also another thing that the IRS does is that if you own the property for 5, 10 plus years, you've been depreciating that every single year, right? Well, the IRS wants 25% of that back that you've been depreciating your taxes over the last 5, 10 years, whatever you were on that number. So if you depreciated $50,000 is what the number you depreciated. When you sell that property and don't do a 1031 exchange, they want 25% of that back. Okay? Now here's the kicker. Some people will come back and argue and say, well, I never took any depreciation on my house that I've owned for 10 years. Doesn't matter. The IRS will take 25% of what you should have. depreciated.
You know, it's funny,
Mhm.
the election to depreciate here is pretty much mandatory because
Yeah.
of that.
Yeah.
However, other countries, it's an election.
Right.
So when I have investors come from, say, Canada, I have to explain to them that it's not a choice here, you take it.
Yeah, you take it. If you don't, you're gonna be penalized later, so.
So you always should take depreciation?
You should always take the depreciation, yes,
Yeah.
absolutely.
On our spreadsheet classes, we go into how to do the depreciation numbers pretty carefully. Mike will tell you about that. So we gotta do another spreadsheet class soon. Okay.
So then, the other tax that's kind of part of the capital gains when you sell the property is the PPACA tax, the 3.8%. Most people don't have a clue what that is. It's the Affordable Medical Obamacare tax.
Can we tell you that that was put on in the last 4 hours of the bill?
Yeah, it
Thank
was.
you very much.
Yeah, it was slipped in over the holidays and put in there. So it's not a free medical, it's 3.8% is what you're.
Can I speak for this
Yeah.
just for a
Yeah,
second?
go ahead.
So on this 3.8% tax, I have a 90-minute presentation that was given by the CCIM Institute on how to figure this out.
Mhm.
And I've sat through that 90-minute watching paint on the drive
Right.
presentation, how they figure that 3.8, because it's not a flat 3.8.
Right.
I still don't understand it. So if anybody wants to sit through that presentation, I'll be happy to invite you to the doc for it, but oh my gosh.
Yes. Yeah, I mean, for my purposes, I'm just gonna generalize today, but it's approximately 3.8%. So if you do the math on this, you got minimum 15% federal you have to pay, could be a maximum 13.3%. Then you got the 25% depreciation recapture and 3.8%. So $100,000 gain, you might be paying $30,000 just for your capital gains to Uncle Sam, plus the 25% of recapture of what you depreciated. So you could be $50,000 on that $100,000 gain, almost half of it, depending on how long you own the property. So always look into or go through a tax advisor to get an idea. Or we can't give tax advice; we give you ballpark, but at least consider what your options are prior to the sale of the property. Okay, moving on. So again, here's just an example. This is kind of touching on a property that it's $1 million. We like to use $1 million, nice round number. Wants to sell the property and purchase 3 investment properties. This happens quite a bit now. People are diversifying maybe and buying different properties instead of just one. So you hire a realtor, like I was just saying, that you want to hire somebody that knows about the 1031 exchanges, or at least has a contact information for somebody that's in my position. Because as a realtor, if you're a licensed realtor, your fiduciary responsibility is to advise them on all their responsibilities. And if it's an investor, simply you can just ask them, are you or have you considered doing a 1031 exchange? Some will look at you and have no clue, and then you would want to give them some basic information or at least put them in the right direction. Because if they sell and they're at the signing table and you didn't advise them on that, and they find out that there's a huge tax burden that they have to pay at the last minute, we can still accommodate and put it together for them at the last minute as long as they contact us before they close. But they're going to be a little bit more frustrated if you didn't bring it up to them and it's at that last minute. They'd be more frustrated if they found out when they file the taxes next year after the sale and they have to write a check and there's nothing that they can do. So always do your fiduciary responsibility. So with this example, they have $1 million of equity in this property. This is one option that they can do to just sell and pay their taxes. In this case, just round it off and be about $300,000. Nice check to write to Uncle Sam, right? Then they still have $700,000 of net equity left over, and they want to buy some properties. So at 33% down, that will buy them $2.1 million worth of real estate. Okay, so they're doubling what their assets are and moving forward and still paying their taxes. Not a bad scenario, right? The other option would be to do a 1031 exchange, preserves 100% of that equity, so now they have $1 million, and if they use the same example, 33% down, that is going to give them $3 million worth of real estate.
I have a gentleman coming in this weekend.
Yeah.
Who's coming out of an exchange. He has sold he's closed on his relinquished property.
Mm-hmm.
He has $1.8 million to place and he's going to leverage. his building was owned free and clear, 1.8 million. So we're looking in the $4 to $6 million range of property right
Right.
now. He's delighted that he's able to do that.
Right. Yeah, and just that's from doing a 1031 exchange. Gives you more real estate purchasing power. And that's covering there. So then, for the non-tax reasons, well, investment strategy with land. Well, the biggest thing is that if you have any clients or you have a parcel of land, you don't have to worry so much about depreciating it because you cannot depreciate land. There is no cash flow from land. So when you sell that land, here's an opportunity to, because like I said, you can exchange into like kind, which could be an approved commercial strip center. So now you got that land that you've been sitting on and it's appreciated and you have some equity in it. Rather than just sit on it, this is a good time that maybe your client or yourself may want to exchange into a commercial strip mall or single family. The other reason, non-tax reason, is that you may want to consolidate. So I had a call, what was it, actually 2 months ago now because we're in July. Gentleman down south in Gilbert, during the bust, went to the auction house and bought, I think, over 50 houses, all at really low prices. And he's been renting them out since 2005-06. Now he's called me up, he's got these 52 houses that he wants to sell and get into like multifamily, storage units, or commercial. So he's going to be consolidating all those properties. It's a little bit of a challenge when you have that many properties to sell it all at once and then do one exchange. So he's actually going to have to do about 5 exchanges and break them up in 10 parcels is what he's been doing.
Could we also say that you need someone who's extremely knowledgeable
Yes.
as a broker to
Right.
understand how to position everything
Right.
and guide the transactions
Right.
to close pretty close to the same time?
Absolutely. So I work with only brokers that understand the concepts of 1031 exchange, not just the contact information. And Linda is very experienced in what 1031 exchanges are. So that's that particular one. He had a relationship with somebody he's working with. The other thing is to diversify. You don't want to be stuck in one market. I like Phoenix. Phoenix is a great market, but you never know in the future if it tanks again. You want to have maybe your properties in different areas of the country. So when you're doing a 1031 exchange, you can exchange. I put the U.S. Virgin Islands on there because that is the U.S. You can qualify to exchange and buy purchase properties there. Hawaii and obviously San Diego, but anywhere in the United States you can exchange into. Yeah.
That's a good question. I thought that you could also buy overseas.
No, you can, but not with a 1031 exchange funds. No.
Really? Okay.
It's got to be within the United States. Canadians, our friends up north, when they have properties here, that question comes up a lot because they want to sell here and then buy or pay off their primary residence in Canada with the funds. They can't. They have to keep it in the United States. That's one of the reasons why the 1031 exchange tax code was written, to kind of stimulate the economy that it's boosting and putting you on a timeline. You have to continue to keep purchasing real estate, which obviously helps out the economy. If it's going to another country, it's not really doing anything for the United States. So no, you cannot. Good question though. So then property exchange, single land, single family into an office, commercial building. And here's what I kind of touched on earlier is the estate planning. So you got that same client, owns investment property. He's in the later golden years, which a lot of our clients here in Arizona are in the upper golden years. And they might have properties that they bought and paid for 10, 20, 30 years ago. But this example here is that he has 3 children. I don't know how many of you have been involved with inheritance. I personally have been involved with an inheritance. My dad inherited my grandfather's estate. There was over 25 houses that were in the estate, and he had 1 brother. My grandmother passed away 2 years ago, so he was in the process of redoing his will. He wasn't finished because it was within a 2-year period of time, and he died unexpectedly. So he didn't really have it broken down on who got what. Needless to say, that was a large estate. My dad and my uncle fought over which piece of pie they wanted, and his new bride that my grandfather married wanted her share. So anyway, after about 2 or 3 years of fighting in court on what got what, lost a lot of money into legal fees, they do not talk, my uncle and my father, and that was over 35 years ago. So this example here might help out with some of those options. when you have that. So you have an investment property that it's worth $1 million. What he could do is that he could go to his 3 children, and they might live all over the country, and say, okay, I'm getting into my golden years now. I want to help do some estate planning. Instead of having this one property that you might fight over upon my death, because one may want to keep it, one might want to sell it, and one might just want to take a piece out of it and refinance. So they might all have different ideas. So Dad's going to sell this $1 million property. He's going to go his first child, second child, and third child, say, okay, you got about this amount of money, $33,000, to find a property in your general area that you will inherit in the future. It's still going to be Dad's. It's going to be in a trust, and you manage that property. So down the line, when I pass on, they have more options. They can decide that if they want to keep it, they don't have to deal with any of these things. No fighting, no probate. The kids inherit their building, and whatever the value is at the time that they inherit it, they don't have to pay any of that back taxes that Dad deferred. So then they can continue to stay with that property if they want to, or they could sell it, they can do whatever they want. So it avoids all those issues that my family had to deal with. Okay, continuing on with that, well, like I said, death and taxes. Well, there was wrong because of that estate planning. So a lot of people don't think of 1031 exchanges as a way to do estate planning. I work with a lot of wealth managers and advisors, and this is one of the things that we talk about is 1031 exchanges for that purpose. So taxes, so again, at 2014, children inherit property at a stepped-up basis. And as of 2013 January, non-spouse taxpayers who inherit property will be able to increase the basis up to $5 million. What that means is if it's over $5 million, the step-up basis doesn't apply with inheritance tax. They have to pay it if it's over that, depending on what the estate is worth. That number could change. It is reviewing currently, so it could go up or it could go down. At the moment, it's at $5 million, okay, for inheritance estates. Oops, I think I'm hitting the bottom of there. Yeah, I am. I go back.
I might want to
Yeah.
add, one of the reasons that my client that's coming in this weekend
Yeah.
is selling is because he's owned this building free and clear for over 39 years.
Oh, wow, okay, so it's
So
probably fully
he's
depreciated.
fully depreciated. The only reason he's selling this building is because he needs the depreciation against his other assets.
Right.
So that's the only reason he sold.
Right.
That's a great place to be.
That is a great, I mean, I'm not going to cover it in the basic class, but that is a way to market clients if you're a realtor to encourage them to sell that property because it's fully depreciated. They can literally take that $1 million property, buy another $1 million property down the street, exact same building almost. Now they can start over a new depreciation schedule on that building. So it's going to benefit them in their taxes by doing something like that. So before they may be like, oh, you know, I'm collecting my rent on this building, everything's great, it's going up in value, it's bought and paid for. If I sell, I'm going to have to pay all these taxes, I don't want to deal with that. So a way that you could suggest to them is that, well, you could sell this, do a 1031 exchange, don't pay any of those taxes, just defers onto the new property. They can get a new property, and now you got a new depreciation on that new building that you can continue to collect on your taxes. So yeah, very good for your client on that respect. So this estate plan, Dad did that flip to them, and they bought their properties at $333,000. This is a perfect world. Nothing's gonna be exactly numbers like this, but they sell it now. It's worth $500,000, or they may not want to sell it. I'll go back to that slide really because I want to touch on that. So if you're a realtor and you're working with your client on this, or you're an investor and you own this property that you just inherited, one thing you want to do as soon as you inherit that property is go get an appraisal on that property. Because in the future, you're going to want to prove what your stepped up basis value is, rather than the IRS going back and just looking up on whatever website they want to come up with a value. It's better for you to have that documented value of what that property is worth when you inherit that property. Either for A, to sell it, or B, to hang on to it, so that you know where your basis or your bottom line is, and then from that point on, that's what you're going to be paying taxes on if you sell it in the future. Okay. Any questions on that? You good? Okay, so this is just the timeline on the exchange. If you call me, I'm going to look at your client or you individually as an exchanger, which is the investor, the property owner. Then there's using some of the vocabulary in our industry. It's the relinquished property is the property that's being sold, a selling property. So you might hear me say, what's the relinquished property? Is closing of escrow. That's the word that we use for the selling property. And then the replacement property is the property or properties that they're looking at to purchase. It's the lingo in our industry. So then you got the exchanger. The relinquished property in this example is a condo in Colorado. You got the buyer. QI is the qualified intermediary, which is our company. We hold those funds until he finds a replacement property. Those funds go to that seller of that replacement property, and then the exchanger gets the deed and title of that property. That's just kind of the flow of the delayed